Hey everyone, it's Julie here with TipRanks, and today we're taking a look at two beaten down tech stocks that are still rated a strong buy. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at two fairly big names in the technology industry whose stocks have been taking a beating lately, but they are still coming in with a strong buy consensus from Wall Street analysts. Both of these companies have some AI-driven growth potential, but have been facing some near-term challenges. Analysts think that these challenges might make these stocks a great bargain right now. So we're going to take a look at these stocks, what it is that they do and what's been going on lately, and of course what those Wall Street analysts are predicting for the stock's future. You can follow along over on the TipRanks website or right on the TipRanks mobile app by following links in the description down below. Let's dive right into these two beaten down tech stocks. First up, we're taking a look at Block, the company formerly known as Square. They trade under the ticker XYZ, currently priced at $66.80 per share. Overall, the stock is down 10.5% in the past year, but has fallen more drastically recently. In the past week, it's declined over 19% following their latest quarterly report. Block is a financial services company offering payment processing and point-of-sale systems. Their Square products allow merchants to accept payments, manage operations, and grow online, while their Cash App is for peer-to-peer payments, banking, and investing, and in fact is where most of the company's revenue is generated. Block also focuses on Bitcoin and blockchain initiatives aiming to democratize finance through technology. As you saw on the stock chart there, Block did take a big hit last week on February 20th after they came out with a miss for their fourth quarter earnings report and some underwhelming first quarter guidance. For their fourth quarter, they reported earnings per share of 71 cents, falling 17 cents short of analyst expectations, while revenue came in at $6.03 billion, missing by $230 million. Gross profit of $2.31 billion did grow 14% year over year. However, investors are concerned about the slower growth in their Square merchant services and Cash App amid economic pressures like inflation and reduced consumer spending. Looking forward, the company is anticipating full-year 2025 gross profit of $10.22 billion, which was a bit below analyst expectations. They did say that they expect Cash App and Square to improve meaningfully in the back half of the year. We've seen quite a few Wall Street analysts weigh in on the stock following that earnings report, one of them coming in just today from BMO, where they actually upgraded the stock to a buy. The firm now sees an attractive entry point following the post-Q4 earnings sell-off. Street estimates now have less downside risk, while investor sentiment and positioning are more balanced. BMO believes expectations for their Cash App's gross profit growth appear more achievable, with higher spend now contemplated in estimates. Block's valuation is attractive at current levels, especially if estimates have indeed bottomed. We have seen several analysts lower their price targets while maintaining buy ratings, including ratings coming in just today from Piper Sandler and Canaccord, who did say that Q1 is expected to be the low point in terms of gross profit, with sequential acceleration through the rest of the year. With 28 current analyst ratings, the Block stock does come in as a strong buy, with 25 buys, 2 holds, and 1 sell. The average price target comes in just above $100 per share, implying an upside potential of 51%, but we do have quite a wide range of price targets. On the low end, we have our sell rating here at $65, which would be a downside of 2.5%, while our high-end price target, we have a couple analysts at the $120 price point, which would be an upside of about 80%. For our second beaten down tech stock, we're taking a look at Dell Technologies. Trading under the ticker Dell or DELL, they're currently priced at $114 per share. Now this stock is in the green overall in the past year, up 25%, but recently in the last 3 months, it's fallen 20%. Dell is a global technology company that designs, develops, and sells a wide range of hardware, software, and services. They are one of the world's largest manufacturers of personal computers, offering a broad portfolio of laptops, desktops, and workstations, and they also have their infrastructure solutions group providing servers, storage solutions, and networking equipment. They've also become a leader in AI infrastructure, particularly with their AI-optimized servers and storage solutions powered by GPUs from partners like NVIDIA. Beyond that, they offer software for data management, support hybrid and multi-cloud environments through their cloud and edge computing, and offer consumer and business solutions. Dell's fourth quarter earnings report is actually coming up in just a few days on the 27th. The stock has been sliding since their last quarterly report back in November, where revenue did fall short of analyst expectations and their future guidance also underwhelmed. For their fourth quarter, analysts are anticipating earnings per share of $2.52, which would be a 32-cent increase from last year. For their third quarter, they came in with earnings per share of $2.15, which did beat expectations by 9 cents per share. However, their revenue of $24.4 billion did miss expectations by $350 million. Investors were also concerned about compressed margins in the AI server business, and their fourth quarter revenue guidance of $24 to $25 billion did come in over $500 million below expectations. The conservative outlook, despite strong AI server demand, raised concerns about growth, sustainability, and execution. This is another stock that we've seen several analysts slightly lower their price targets on, but maintaining buy ratings. One of them came in just a few days ago from Citi. They said, from a fundamental perspective, overall infrastructure demand indicators remain constructive, with supply chain commentary suggesting a broader recovery in infrastructure demand. They say on AI, bullish expectations ahead are offset with near-term lumpiness and margin pressures amid chip transitions. We also heard from an analyst at Bank of America who reiterated their buy rating. Ahead of the Q4 report, they believe the discussion will be focused on the company's AI server backlog as well as Blackwell delays. While Dell's near-term setup could be challenged on AI server revenue and margins, this will be transitory. Bank of America believes that as Dell begins to deliver on the demand for AI servers and customers shift to more enterprise, its revenue and margins should shift higher over time. Dell Technologies has 16 current analyst ratings, coming in as a strong buy with 14 buys and 2 holds. And the average price target comes in at $146, implying an upside potential of 27.5%. Looking at those price targets down below, again, you can see several where they did slightly lower their price targets, but all pretty much have double-digit upside potential. Our one low end here is $115, which would be a flat price target, while our high-end price target is $185 for an upside of over 60%. So that is a quick look at 2 tech stocks that have been facing some near-term challenges, but Wall Street analysts have been maintaining their buy ratings on. Let me know your thoughts on these 2 companies and whether you think they're going to turn it around soon. I always appreciate hearing from you guys. Of course, please keep in mind these videos are never a suggestion to buy or sell any specific stock, just sharing what those Wall Street analysts are up to, so please make sure you always do your own research and due diligence. Thank you guys so much for watching. Have a fabulous day. I'll see you back here next time.